Reserve Bank this week has cut the official cash rate to a record low of 1%. This was no surprise to the market and economists alike, with credit markets well and truly pricing in the cut in advance. So moves in the market and the Aussie dollar were not that dramatic. In fact, the 2 rate cuts just passed have been amongst the most telegraphed decisions by the RBA in recent memory. Both our economist Michael Knox and the consensus of market opinion are predicting a further cut in the cash rate to only 0.75% by the end of this year. This is in an effort to stimulate consumer spending and employment and to lift inflation toward the RBA's target range. Now, most of the major banks haven't actually passed on the full savings created by the cut to their borrowers, so you may notice increasing concern in the market that the full theoretical benefit of rate cuts is diminishing the lower they actually get. Consumers are actually really concerned about the economic backdrop that is actually forcing these cuts in the first place, and probably have their house prices at front of mind as well. We've noted in our recent work that what's really required to assist the economy is genuine reform. Proposed tax cuts are a first step, but Michael Knox is calling for broader productivity reform and public investment into productive infrastructure, which governments are already doing, but this takes time. In terms of the equity markets, these are really abnormal times. If the low rates environment is persistent for a prolonged period, then high-yielding equities will generate very strong relative returns. And the opposite is also true. This explains the market testing record highs just recently, helped by strength in high-yielding banks, REITs and utility stocks, against the record lows in long bond rates seen in this country at around 1.3%. What we're concerned about is the earnings power of companies in a potentially weaker environment and whether their dividends are actually sustainable. So we therefore caution investors against complacency at a time when, yes, share prices might be very strong, but they're at abnormally high valuations. As always and overall, we're seeking companies with exposure to high quality fundamentals with robust cash flows that can weather all parts of the economic cycle. Our upcoming investment strategy Winter 2019 Outlook edition covers these issues in a lot of detail.